Hi, my name is Dean Mead, and I am a partner and government and public sector subline leader with Carr, and Ingram, or CRI. This is the last of 5 brief videos about deferred inflows of resources and deferred outflows of resources. We've talked so far about what deferrals are, where they came from, and what they do, particularly with respect to pensions and other post-employment benefits, or OPEB. Let's turn our attention now to what the information about deferrals means and what it tells us about a government's financial health. This is a real example of one of the schedules that governments present about their pensions and OPEB plans as required supplementary information following the notes. It shows the causes of increases and decreases in the net liability over time. The types of things discussed in the 4th video in this series, what are pension and OPEB deferrals, such as interest, changes in assumptions, benefit payments, and investment earnings. Looking at this information in connection with the note to financial statements on pension and OPEB deferrals, which we also first looked at in the 4th video, can inform us about how growth or decline in the size of the net pension or OPEB liability will translate into more or less pension and OPEB expense in the future. We can see here that this government's net pension liability grew steadily from almost $114 million in 2018 to nearly $211 million in 2024, an increase of 85%. In 2025, however, the net liability dropped 21% to under $166 million. If we look at the individual changes in the total liability and fiduciary net position of the pension plan for 2025, we can see that the decrease in the net liability is a result of a substantial increase in the plan's investment earnings, from less than $3 million in 2024 to over $55 million in 2025. What will happen to future pension expense as a result of those notable changes in the net liability? We can start to answer that question by comparing the pension deferrals disclosure for 2024 and 2025. In 2024, this government had a deferred outflow of $16 million related to the difference between projected and actual plan investment earnings. After the substantial investment earnings in 2025, the deferred outflow had become a deferred inflow of more than $37 million. One should expect that a swing of that magnitude will have a noticeable impact on future pension expense. Indeed, when we compare the 2024 disclosure of how the deferrals will be reported in future pension expense with the 2025 disclosure, the amounts are noticeably changed. The 2024 disclosure reports that the accumulated deferrals will add $13.3 million to pension expense in 2027. The 2025 disclosure, by contrast, says that just $306,000 will be added to pension expense in 2027. And in the next 3 years, what had been expected additions to pension expense as of 2024 are now deductions from pension expense as of 2025. In the 3rd video in this series, Why Are Deferrals Important?, we talked about transactions called hedging derivative instruments. The information that governments disclose about their hedging derivative instruments can be useful for identifying potential financial demands on a government. In the example here, we see that in 2025, this government had a deferred outflow of $14 million related to one of its hedging derivative instruments. Technically, if for some reason that hedge were to be terminated, the government might have to pay the other party to the transaction that $14 million. Can it afford to do so? That's a good question to explore further. Looking at the same derivative instrument in 2026, the deferred outflow has grown more than 50% to over $21 million. In other words, the potential payout the government faces is even greater in 2025. That is potentially valuable information to someone examining the government's financial health going forward. CRI provides a range of free resources to help you understand deferrals. In addition to a recording of a detailed presentation, Demystifying Deferrals, there are other short takes videos answering key questions about deferrals, as well as slide decks for all of the recordings, a companion slide deck that dives into the technical requirements of all of the deferrals required by the GASB, including debits and credits, a short plain language article that covers deferrals in a nutshell, a longer plain language article that covers the same ground as the detailed presentation, A third plain language article that explores how municipal bond analysts, taxpayer associations, legislative staff, and other users of financial statements can utilize deferrals information to evaluate a government's financial health, make decisions, and assess government accountability. And best of all, an ebook that encompasses all of those resources and can be found on CRI's website at criadv.com.